Most small businesses are in one of two categories: service or sales. Service organizations are businesses that provide a service rather than a tangible product for their customers. Businesses such as beauty shops, bookkeeping or accounting firms, web design and hosting organizations, and real estate firms are examples of service organizations. Sales organizations are businesses that sell tangible products to their consumers. Businesses such as hardware stores, grocery stores, and car dealerships are examples of sales organizations. Wholesalers are organizations that purchase goods directly from the manufacturer and sell them to retailers. Retailers are firms that buy goods at wholesale and sell them to consumers. They maintain a stock or inventory of goods for sale and are also called merchandisers. However, the categories may overlap, as service firms may sell some goods and retailers may provide some services. But the discussion in this video pertains to the retail aspect of any firm. Certain journal entries and calculations are primarily performed in merchandising operations, sales returns, purchase discounts, and inventory. The accountant for a merchandising firm must compute the cost of goods sold as part of the income statement. Cost of goods sold is a total cost to manufacture or to procure items that were sold at retail. Goods returned must also be accounted for. Gross or total revenues minus returns equals net sales or net customer purchases. The gross profit figure is used to calculate the operating margin of the business. Operating margin is used as a guide to set pricing and is computed by dividing the gross profit on sales by the gross sales. The result will be the percentage by which goods must be marked up to cover their actual cost. However, the income statement at this point does not account for stock remaining on hand for sale or inventory, which must be added back in, or reducing profit, to determine gross profit. This is an important factor. Since we have not sold the remaining inventory, it must count against us when we're determining our profit. The remaining expenses of the business are then totaled and deducted in the usual fashion to arrive at the net income. Inventory. In determining the value of inventory at the end of an accounting period, the amount on hand at the beginning must be known, the value of goods purchased during the accounting period must be added, and the value of goods sold or shipped back must be subtracted. The following example shows how adjustments for inventory and returns are made in calculating the cost of goods sold. Note that a value must be assigned to the inventory in order to make this computation. Beginning inventory plus net purchases equals goods available for sale minus ending inventory equals cost of goods sold. The inventory value is computed by counting the goods and then assigning a value to them. Sometimes an actual physical count is done only at the end of the year or quarter. Interim counts are approximated from records of purchase and sale. Computer programs can be designed to accomplish this. Barcodes on UPC labels are often used to track the sale of items and adjust the computerized inventory of that item. Physical inventory, or counting items and adding up the price tags, helps determine how much is being lost through shoplifting or employee pilferage and provides a check of the accuracy of the accounting records. Goods may be valued at wholesale cost or at the retail price. Often both calculations are performed. Wholesale value. The cost of the same goods can vary over an accounting period and with the size of orders. Suppose 25 units of a given item were purchased in January at $150 each, and 15 more units were purchased in February at $165 each. What was the cost of one unit sold in March? One method is to assume that the oldest item was sold first and to price the goods sold at $150. This is called the FIFO method. FIFO is the first in, first out method of assigning wholesale value to inventory. An alternative is to assume that the most recently purchased item, or the one bought in February, was sold and to list its cost at $165. This is called the Lifo method. LIFO is the last in, first out method of assigning wholesale value to inventory. In large computerized operations, a shipment number that permits valuing each item at its actual cost may be used to track merchandise. For smaller firms, FIFO or LIFO estimates may suffice. Whichever method is being used, this may be dictated by tax considerations. The accountant should use it consistently. Retail value. The firm's owners may wish to know the retail value of inventory for tax reasons, for insurance purposes, or to compute the value of the business when it is sold. If the firm customarily marks up its merchandise by the same percentage over cost, say 35%, the retail value can be computed by multiplying the wholesale value of the entire inventory by 1.35. If different items are marked up by different amounts, the only alternative may be to physically examine each price tag. Returned goods. When a sale is made, sales is credited and cash is debited. It will be simple merely to reverse this process when goods are returned, debiting sales and crediting cash. This may suffice in a service business where returns do not occur regularly in business operations. In a merchandising operation, however, it is customary to have a ledger T account called sales returns and allowances. When a return is made, the accountant debits the sales and allowance account and credits cash or accounts receivable depending on whether the sale was a cash or a charge transaction. This method shows management the value of goods with which the customers were dissatisfied. Sales returns are a contra account that works against the sales account and is ultimately subtracted from it. Purchase discounts. Purchase discounts are reductions in price that vendors offer merchandising firms for quantity orders or for prompt payment. To show discounts gained, the accountant must establish a ledger T account for purchase discounts. When a discount is taken on a transaction, the accountant debits accounts payable, credits cash, and credits purchase discounts. Once all adjustments for inventory and returns have been made, operating expenses are entered and the income statement is completed as it would be for a service business. In summary, you are exposed to accounts used in merchandising or sales operations. You are introduced to new terms, inventory, and items on hand for sale. There are several ways to determine the value of inventory. The two most common are FIFO and LIFO. The valuation of the inventory is important because this is part of determining the cost of goods sold. We all have returned items to the store, but we probably did not think about the effect this may have on the business. The sales returns and allowance account provides valuable information to management, the extent of customer dissatisfaction. Also, you learned about a new kind of account called a contra account, which works against the asset account. In this case, the sales return account is the contra account to the sales account. You also learn how to account for purchase discounts.